I'd like to thank everyone for joining today's webinar. Today's topic, we're going to be covering the use of a self-directed IRA and 401k, and in particular we're going to be talking about how to use a self-directed IRA and or 401k as it relates to investing in oil and natural gas exploration. Today's guest is going to be Ascenergy, and our guest presenter for Ascenergy will be Mr. Joey Galbadon. So the format will be as follows. We'll go ahead and basically take up hopefully no more than an hour of your time today. We're going to make sure that we give you some good information and education on how this whole process works, in addition to exactly where the oil and gas exploration is going as it relates to the near future with the fracking technology. Before we get started, just kind of let everyone know we're going to be recording today's session, and within the next day or two we'll be sending out a playback link. So for those of you who are maybe can't stay on the entire presentation, or if you want to pass this information along to share with others, that playback link will be coming out within the next 1 or 2 business days. The actual presentation will be in a mute, as it relates to attendees, you will be in a muted mode to where you will only be able to communicate with us towards the last 10, actually throughout the entire presentation you can actually chat with us, and towards the very last 10 minutes of the presentation we'll open up for Q&A. So what will happen is we'll go and basically get started within the next few minutes here. Before we get started, just kind of give you a background on myself. Once again, I'm the Director of Business Development for AccuPlan Benefit Services. I cover all of Northern California. However, my reach as it relates to investments or investors is nationwide. With the self-directed IRA and 401k, you're able to invest in everything with the exception of life insurance and collectibles. My background consists of 28+ years in various financial areas and experience when it comes to using different investment procedures and outlets when it comes to raising capital and so on and so forth. Within the last 13, 14 years, before serving 8 years in the self-directed IRA industry, I was also in the mortgage business, run several businesses throughout the years, worked with other large financial institutions. So I have pretty much a breadth of information that I can share with both my business partners as well as my clients when it comes to using a self-directed plan. One of our caveats is that our objective is to educate, not to give any form of tax or legal advice. So with that being said, the information that we'll be sharing today is for education and informational purposes only. The objective is for you to retain the information, share it with your financial professionals, legal or tax professionals before moving forward with any type of investment. So what we're going to do is turn this over to Mr. Galbadon for Ascenergy.com. Like I said, he'll start the first 20 to 25 minutes, and thereafter I'll basically talk about the self-directed plan and how that works and how it ties into this type of investment, which is a private placement investment in oil and gas, gas and exploration. So what we're going to do is go ahead and turn this over to Mr. Galbadon, and we'll go ahead and get started.
Okay, let's see. Let me go ahead and share this. Okay, here we go. Well, good afternoon, everybody. It's lunchtime for people here on the West Coast and mid-afternoon for everybody else. My name is Joey Galbadon. Lamarr, thank you so much for the introduction. And for the next 25 to 30 minutes, we're going to have a brief presentation, give you an overview of Ascenergy and oil and gas in general, and why us versus the other companies. And we'll have time for questions and answers. If somebody does chat or send an email, I might not see that on my screen, but we'll get that figured out. So anyways, we also have Dwayne Leonard. He's with me, Business Development, and he's also on the panelist as well. This thing that you see in front of your screen, it's Ascenergy. You see the map of Texas. This is where we're focusing our efforts. And you can see the diversification. We're not just a one well or one field type of company. We love diversification. A little bit about me. I've got a background of, I was a young, successful entrepreneur and built a multi-million-dollar company. I pursued my MBA at the University of New Mexico in finance. And since then, I was semi-retared. I did a lot of investments, a lot of trading. I was very successful at losing a lot of money. And eventually, I learned the elements of hedging, of diversification, and I started throwing those into my trading platforms. And so Ascenergy, what you're going to see is kind of a hybrid of an oil and gas company along with a lot of hedging. Because as I age, what I don't like doing is losing money. I realize life is a portfolio, and you want to be more right than wrong. So anyways, welcome to Ascenergy. So what fuels us, pun intended. So you've got the aspirations for more money. All of us don't have enough. We're all pursuing more money so we can do more things with it. We're also at the age or the wisdom where you can have all the money in the world, but when you're struck with cancer or things that challenge your health or your lifestyle, you kind of shift values over to health supersedes money. So we're actually focused in both. We call it mutual prosperity, and the first objective of Ascenergy is to exceed all expectations with all of our investors. We try to do that in multiple ways that I'll explain later in these slides. And the second thing is, once we pay off our investors, we hope to focus on Ascenergy.org. And that's just a company that's designed to do a paradigm shift for treatment of disease. We've got a lot of neat little incubator type things in there that we would like to put some resources behind. And so that's kind of a little bit about Ascenergy. Now, why did we choose oil? Why real estate? And why a bond? Let's start with the first. So oil, as many of you know, it's a nice product because for a number of reasons. It's a commodity, so you don't have to spend resources on branding or a product or things of that sort. Oftentimes, companies such as like Nike, they've got to spend a lot of money to get that brand labeled to come out with their shoes, and it's very risky for any company when you get into, because Nike's shoes from last year that are sitting in a storage probably have lost a tremendous amount of value. Oil is kind of a little different because the oil from last year is typically worth more this year. So it's a really good inflation hedge, really good asset to have. And that's why we're pursuing oil. There's also big money in oil. So to pursue our second endeavor, we're in the right field. Why real estate? When we discuss real estate, we're focusing not on real estate homes like most people think. We're focused on land that contains oil underneath. And unlike land, oil-bearing real estate is very liquid. So if you ever need cash, you can always flip your property. In this case, it would be a leasehold. Now, why do we choose a bond? Why not equity or different instruments out there? Well, your bond is your most conservative investment. When you purchase a bond with our company or with any company, you have the first lien on any asset to that company. And typically, that's why you get your lower rates with a bond. Anything goes south, you're first in line to get payment. Bonds are also fixed. When you get into an equity position with private placements, such as I have, some people on the phone might have as well, you run into liquidity issues. So when you purchase a stock in a young growing company with lots of potential, and unless they go public, which I think it's 2% of startups end up going public, unless they go public, you've got these private shares, but you can't really sell them. You run into illiquidity. With a bond, you know exactly the rate that you're getting and your exit. And we supersize this bond, and we'll go into that a little later. We made it exciting. We have friends and family as investors, and we certainly want them to partake in our success. So we created a hybridized bond, and you get the upside of equity, but the security of a bond. We'll get into that a little bit later. And this thing that you see on the lower left, there's been as most of you have seen the headlines in the news, where the U.S. has just been the best producer of oil and gas. We're supposedly in the next 3 or 5 years, we're going to be independent with oil and gas. And if you can notice this big spike around 2009, something took place, and this represents North Dakota, the famous Bakken play over there, and many other plays. And what happened around that time is horizontal drilling and fracking. Some of you have heard of both of those. Some of you have just heard of one of those. But really, those two things are married together permanently. And those things have created a big shift in oil and gas. create a big boom because of the economics. Horizontal drilling has been around for a long time, probably 80 years or so, and the same thing with fracking. What's happened right around 2008 or so is both of these became economical, and because they're economical, most companies are using this technology because it's so economical to explore for oil and gas, and we are also. We're going to be part of this big rush, or we are part of this big rush. First, I'd like to get right to it. With any investment, the first and foremost thing that's on every investor's mind is the R word, the four-letter bad word, and it's risk. So use this word, and insurance people really know how to break this word down, and we broke it down with Ascenergy. So you've got your perceived risk. If you hear oil and gas, some people might perceive that as being safe. Many will perceive that as being risky. So let's take perceived risk and make it true effective risk. And through this whole presentation, I'm going to be mentioning probabilities or odds of failure of success. And what you can see by how we engineered this company, to give you a little background, we've drilled 2 wells so far in Oklahoma, and we found oil and gas in both. So far we've got a really nice track record. We've got about 20 million in oil reserves, and we've produced about $1 million. And these are vertical wells, not horizontal wells. They're our first 2 exploratory wells in Oklahoma. So we've got right out of the gate, we've got a really nice track record. Well, we're not going to hinge on that track record. We think Murphy's Law applies to everything, so we're going to welcome Murphy's Law and welcome it into our portfolio. And we're going to show you how we've mitigated risk. Therefore, our probability of failure is very, very, very low. Our probability of success is very, very high. Now, why is this? It's because how we designed Ascenergy. So, and we'll get into this a little bit more, but basically we've got diversification in just about everything. And this is coming up on the next slide. So why Ascenergy? Carrying on with this risk mitigation is how we started out. To give you a little history, we've gone through over 200 top industry picks. This is the cream of the crop from different geologists, different petroleum engineers. These are the little babies that they would love to drill. And so we got this list. We worked out agreements with these professionals, and then we had our professionals go through this list. And out of that, we've selected about 10%, or actually less than 10%. So we've got basically the cream of the crop. And this is by no accident. This is all by strategy. So far we've got about, we call them the Ascenergy's top 20 signature properties. We've got 20 properties identified in Texas, and there's different phases. The heavy lifting has been done. What I mean by the heavy lifting is the last 4 years we went through this list, and we ran our technologies and everything that we have at our disposal, and we filtered these out. Now we're in the money-raising phase for this next phase, and there's 2 phases. One is to raise money to secure the rights for these leases. Fortunately, we've been successful with that. We've raised a little over $1 million, close to $1.5 million. So we have all the money we need now, and we're in the process of securing these. By the end of June, we should have anywhere from 1 to 3 leased. By the end of December, we should have all 20 of these leased. Next year, we intend to start drilling these different fields. And as you can tell here, there's a lot of diversification, again, done on purpose. So we feel, even though we have 100% batting average, we feel we're going to be 80% accurate. Even if we're not, and we're 90% wrong, due to the nature of the size of these fields, we'll still be able to not only repay our investors, but continue to grow as a company. And basically this map that you see here on the left, there's about 20 properties. You can see the diversification. Not only are these in different counties in Texas, but they're also different fields of different depths. And the plan is to drill the top 10, and then we'll go right ahead and turn around and flip the remaining 10. And when I say flip, just sell the remaining 10 to a bigger company who's bigger than us. And there's plenty of those companies out there that would love to come in and explore these, especially since we've already done all the hard work. And then you can see the next phase here, what we'll do after we drill and produce the top 10, then we'll simply focus and expand the top 5. And then again, we'll flip the remaining 5. This is a scalable model. So now why Ascenergy? There's plenty of oil and gas companies, and how I got involved with oil and gas is as an investor, that was one of the latter investments that I made. Typically with your oil and gas company, as many of you may or may not know, but it's usually a one well or a one field type deal. Usually you come in as a limited partner, and basically you share in that in the bounty of that particular well, unless unless you're a really savvy oil and gas investor. You might be able to fare okay with those deals. If you're not, you're going to run into a lot of risk because if that well isn't very prolific, you'll get some nice tax write-offs, but you got to have gains in order to have the tax write-offs. So with Ascenergy, we do not want anybody to lose any money. We want everybody to be a winner. So we've designed it completely different than 99% of all your typical oil and gas deals. We're basically like a mutual fund because we've got so many different properties, and so we do the diversification for you. We'd be the equivalent of investing in 20 different oil companies. I should say 20 different well-run oil and gas companies. So a couple of things here right in front. So I already touched on some of these. The quantity of properties, Ascenergy versus the other companies, we've got diversification in properties and locations. We've got a multiple well and fields approach. We understand and we embrace Murphy's Law. Sometimes things just don't go as planned, and therefore we're not going to be blindsided by that, but we incorporate it. Your other typical energy companies, it's a single boom or bust type mentality. If it booms, life is good. Typically they bust or they're marginal. Income sources, the same type thing with other energy companies. They focus on their production. With us, we can get multiple revenue streams from production as well as flipping our properties. Regarding technologies, most companies use traditional technology. It's called seismic, 2D, 3D, and 4D seismic. We also use that traditional technology, but we also incorporate some other technologies. And we do this because we're very risk adverse. Now, the catch is we do spend a little bit more money than other companies because we use diversified technologies, but we feel that the reward pays off tremendously, and therefore we do this. The bond yield with Ascenergy versus other companies, your real mature companies, your public companies, you're going to get a very low yield. They've got tremendous assets, so in exchange for that safety, you get a low yield. We offer a high yield of 12.5%, and on top of this, this is the part that we're excited about is, hey, making a good return on your money for a mutual fund-based company. That's great, but we wanted to keep it. We wanted to supercharge it, and we got this bonus, and I like to spend a little bit of time getting into this bonus. This bonus, it's based on something that anybody outside of our company can verify. It's based on our gross revenue. And for those of you that do not know, oil production is public information. So you can go onto the state-sponsored site and find out what company A, B, or C is producing. And so we actually based our bonus on our gross revenue, because a lot of people use the word transparency, and words are great if they backed by action. So we backed it by action. In other words, our gross can be third-party verified. We'll produce it on our website, but we welcome anybody else with an internet connection to get onto the Texas railroad commission to verify what our production is. And so that's the nice thing. Other companies with a bond, there is no bonus. If there is bonuses, it's typically for management. So in summary, this is what we have here. It's a secured 2-year bond. It's a 12.5% for annual interest, 25% total interest. And to keep things on top of it even more exciting, we've got this gross revenue sharing bonus that you can make an additional 175%. It's based on a condition, and I'll elaborate this on the next slide. Okay, so here's when we started the offering, November of 2013. So we're still relatively young into it, and you can see here the column in the pink. Look pink on my screen. It's 25%. That's what you would make for the 2-year bond. And you can see in November, for the investors that came in November, they got the highest possible bonus of 175%. This bonus depreciates 6% per month, and we're now in May, so you'd be looking at for anybody who enrolled prior to the end of the month, we're kind of nearing there. It's an additional 139%. Basically, what that comes into, if you're looking for a multiple, it's around 2.5 times your money. Let's go into the condition of how you hit this bonus. It's right here in the print below. For those of you that can't read it, it's based on if we average $5,000 in gross revenue per well per day. So what we do is we take the number of days of production and our gross revenue, we divide that, and you're looking at 5,000. If we look at that in barrels of oil, it's around 50 barrels of oil. Now, the gross revenue also includes gas, so that number would be less. Gas is always associated with oil. And for horizontal drilling, that's a very low number. We've got projections, and I think even on our low estimates, we're looking at averaging 200 at the lowest, most conservative estimate. So we pretty much should blow through that condition that needs to be met for everybody to get the bonus. And this is on top of your regular return. So once we do go into production, this opportunity does stop. Once we prove these fields, we've got, we're in talks now with Oppenheimer and Wells Fargo to get a line of credit to expand our fields. So we, on our website, we're looking to drill next year. Based on how much money we raised so far, we might be able to drill even before then. But to be conservative, we're expecting to be commence drilling next year. So in summary, what is Ascenergy? We're very, very conservative, very fiscally conservative. We've got an incredible amount of diversification. We've got multiple technologies that we use. We've got multiple geologists that we use, multiple petroleum engineers. We've got different sites. We've got a historical good track record. We're 2 for 2 so far. And of course, as Lamarr suggested, you can use your retirement funds as well. So, what we're saying is to not dismiss all your other investments, put everything into Ascenergy, even though we're tremendously diversified. But we're just suggesting that you consider Ascenergy as a relatively low-risk investment. We will put updates up on our website. We not only want our investors to do well, but we also want to educate them through the process so that in the event of if they ever go towards a higher risk play, they'll be armed with a lot more information. So you can see there the little artwork. There's which one of your investments will hatch first. Some people would argue gold. Other people would say under the mattress. And so here's how you can invest. We've got a website. There's the link. It's ascenergy.com. You can schedule a time with any one of us, and we'll be happy to assist you. And And these are the things that you'll be getting when you come in as an investor. Of course, a welcome letter, a countersigned subscription agreement, and a filled out bond. And we also give all our investors, we'll give them quarterly updates, photos of the operations, production reports, sales reports. We have a lot of integrity in terms of our response time to get back to people. So in the days of when it's really hard to reach people, we hold ourselves pretty accountable to getting back to people within 24 hours or less. And that's through email, that's through text, that's through phone calls. It's a 2-year note. We do have a clause that we do have the right to pay people back earlier with no discounts. And what we strive for with Ascenergy is always to exceed expectations. So hopefully we'll continue to do so. And other than that, I'll turn this over for any questions. Thank you so much for your time.
Okay. Perfect. Okay, thanks for a great presentation. A lot of good information that was shared as it relates to how you take advantage of this investment opportunity. As I mentioned earlier, we're always priding ourselves on introducing different investment opportunities using a self-directed plan, and this, of course, through a private placement structure is one of the popular and I say emerging investment opportunities. I would say pretty much up there with real estate, especially as a result of the emerging technology when it comes to fracking. So what we're going to go and do is talk a little bit about how to use a self-directed plan to make this type of investment. So before we get started, I'm going to go and change screens back over to pull up my presentation. And we'll also go into a Q&A session towards the very end of the presentation, so feel free to start to jot in some of your questions through the chat feature, and we'll try to get as many of those questions answered. Any questions we're not able to answer during this this presentation, we'll be happy to answer towards the very end, or you can give us a call or send us an email. So for those that just joined onto the presentation, my name is Lamarr Baxter. I'm the Director of Business Development for AccuPlan Benefit Services. We're a national company as it relates to a self-directed IRA as well as a custodian. As I mentioned, we cover pretty much, we're a national company. We're able to allow for investments throughout the United States as well as international, depending on the structure of the investment. Before we get started, I think we have already gone through the disclaimer, so I just want to just reiterate for those who join late, we provide educational services. We do not provide any form of due diligence or promote any type of investment. As with any investment, you want to make sure you do your due diligence, consult with your tax and legal professional before moving forward with any investment. So we have a pretty expansive staff when it comes to our staff with the self-directed plan. And most will ask, well, what is a self-directed retirement account? Well, it's a generic term, and for those who are not aware, the only restrictions with a truly self-directed plan is life insurance and collectibles. So there's a lot of investment opportunities that's not allowed through your traditional investment that you can actually take advantage of with the self-directed plan. So the whole objective is to be able to invest in both traditional and non-traditional investments, and some of the information that was covered in the Ascenergy presentation through a private placement setup is basically a private placement to where you're not allowed to maybe go through your traditional custodian to make that investment because it's not a public offering. With the emergence of crowdfunding, that's something that's going to also allow a lot more investment through private placement through a crowdfunding structure. So we're pretty excited to be a part of any type of private placement, whether it be for real estate, oil and gas, exploration, or any other type of investment offering. You'll be hearing a lot more of how this structure will be kind of aligned with the self-directed retirement plan. Well, it's estimated that just some of the information that's usually covered are statistics that we like to share before we get started as to why people are moving towards a self-directed plan. It's estimated that 10,000 baby boomers per day will turn 65 for the next 20 years, and of that segment of the population, a good majority will not be able to retire beyond the age of 65. Most will be forced to work beyond the age of 65, depending on if their occupation and their physical and mental ability to work beyond the age of 65 will hopefully allow them to continue working. For those who have limitations depending on their occupation and what their employer will allow, that's going to be somewhat of a stumbling block. So it's really important to be able to take a proactive approach, start to look proactively at a lot of different investments to grow your retirement account. And that's what we like to do, is provide you with information and education to hopefully open your eyes in terms of every investment opportunity out there for you to truly be able to grow your retirement account safely. Retirees will face skyrocketing health care costs and diminished Social Security benefits. A lot of the benefits that were around for our parents and grandparents may not be there for us, so it's important once again to look ahead and be proactive in terms of being self-sustaining when it comes to having our own money to be able to take care of us through our retirement years. Inflation and cost of living increases will definitely threaten to erode our fixed income retirement, so you want to make sure once again that you're looking at the inflation as one of the factors as to why you need to make sure you're progressive as well as proactive when it comes to looking at all the investment options available to you. It is estimated at $4.7 trillion in combined IRA and 401k funds are out there throughout the U.S., and of that $4.7 trillion, only 1% of those funds are invested in traditional, I should say non-traditional or alternative investments. So looking in beyond just your Wall Street investments, this is an excellent vehicle to take advantage of to be able to have more control and be able to grow your retirement safely and securely. It's estimated that up to 90% of the population is not aware of a self-directed plan. Once again, we offer both a self-directed IRA as well as a 401k. So if you're 1099 or W-2 or self-employed, we have a product for you. So of that 90% of the population, that would also include your attorneys and CPAs, your financial planner, as well as any other financial or legal professional, because once again, to all fairness to them, that's not an area that they're well versed when it comes to the tax code. But looking at this is our niche market, and of course, because a lot of their clients beginning to start to ask questions, they want more information on this type of plan, they're basically coming up to speed. As I mentioned, this is a truly generic term, self-directed. So a truly self-directed plan will actually allow you to invest in everything with the exception of life insurance and collectibles. So the sky's the limit beyond the two restrictions of life insurance and collectibles. So diversification is key. We advocate basically investing in every investment opportunity that you think is going to do well for you. So whether it be traditional or non-traditional, we focus on emphasizing diversification. Majority of those funds are invested in, traditional funds are invested in mutual funds and some of your Wall Street investments. And as I mentioned in the previous slide, most of those investments are only 1% of the total $4.7 trillion are invested in non-traditional investments. So these are some of the, I would say, the more common transactions that have come across my desk over the last 8 years that I've been in the industry. And I would say these are not the most popular. I wouldn't say these are the popular or the most popular, but these are the most common transactions because, once again, everyone has their own idea in terms of what they think is best in terms of growing their retirement account. Real estate being, I would say, the #1 asset class, followed by a distant second by private notes and loans, and they have different structures when it comes to investing in private notes and loans. It's not just limited to real estate. So as Joey mentioned, that they basically offer their investment is basically tied to a note. So once again, whether it's through a private placement, a note would be secured or unsecured, there's a lot of different directions you can go in terms of structuring their investment. That's basically a good sound fit for both the investment offerer as well as the investor. Private companies. Ascenergy is one of those companies that is considered a private company where they're basically out looking to raise capital through a private placement offer. And once again, this is a good time for companies like Ascenergy to get out there, especially with the emergence and the release of the crowdfunding rules. You'll see a lot of alternative capital come off the sidelines that were not normally allowed in through some of your traditional sources. Precious metals is, once again, was one of those options that was still available to you, but depending on how well or how bad the economy does will determine whether that is a viable investment. And depending on, once again, the mix of your investment portfolio, you always want to make sure you have a good mix. Precious metals always one of those tangible assets that you want to have held in one of your retirement account portfolios. So just to kind of give you an idea, and this really is to promote you, or should I say urge you to think outside of the box, is to look at some of the list of items or investment opportunities that you have available to you, and it will give you an idea how vast the number of opportunities or options you have in terms of using a self-directed plan to grow your retirement portfolio. I'm sure if you were to contact your current plan custodian where it's only traditional investments allowed, that these investment options would not be available to you. So once again, you have the best of both worlds with the self-directed plan to be able to invest in both traditional and non-traditional investments. So before we get you all excited about all these different opportunities and structures of investments you have available to you, there are rules that must be followed, and the rule that you need to be aware and cognizant of is IRS Code 4975. If you're not too well versed on this area, definitely want to consult with your tax professional and or contact any of your legal professionals that's well versed in this area, because once again, we're not in a position to give you any form of tax and legal advice, but what we will do as your custodian is to let you know what transactions are compliant and non-compliant. We will not allow you to make an investment into a transaction that will basically result in your account being disqualified, taxed, and penalized. So to kind of give you an idea how this works, IRS Code 4975 is a prohibited transaction code, basically restricting any self-dealing or indirect or direct dealing between the IRA account holder and the account. And that would also extend out to certain family members who are considered disqualified parties, and we'll talk about that in the next slide. So basically, IRS is saying these funds are here for you to grow for your retirement years. So they're not so much your funds in terms of accessing now, unless you want to assess both a tax and a penalty to access the funds now. But once you turn the age of 59 and a half and beyond, you have full access to those funds, in which at that point in time, hopefully you've grown your account and you can start to pull those funds out, and you'll be taxed based on your ordinary income tax based on that time that you pull those funds out. So in summary, you want to make sure that there's no direct or indirect dealing between your plan and your retirement account. Just kind of give you an idea, selling or exchanging or leasing properties, lending money or extending credit to yourself or any other disqualified parties is prohibited. So you just want to make sure it's an arm's length transaction. And once again, we're going to make sure as your administrator and custodian to make sure that the transaction does remain arm's length between yourself and any other disqualified person. So just kind of give you an idea as you're thinking about how you're going to use this account for different investments. Disqualified person, these are your examples of who you want to avoid having any direct or indirect business or dealings with your self-directed plan. It's going to be you and your spouse, your parent, your grandparent, children, and grandchildren. In addition to those relatives, you want to make sure that you avoid any types of dealings with any fiduciary directly related or indirectly related to the transaction, meaning your IRA or your 401k. Anyone providing services to your IRA. As I mentioned in my presentations, I'm actually practicing what I preach. I've had a self-directed STEP IRA for the last 15 years, which I basically take the opportunity to invest in real estate secured notes. So I'm always getting questions as to whether I'm willing to invest in different opportunities. I will invest in different opportunities beyond real estate if the numbers make sense. But however, if you are a customer of AccuPlan, IRS basically prohibits any dealing between any employee or person associated with the custodian and the IRA. So I would be also considered a disqualified person. The next question comes up. If you own an existing business, whether it be corporation or partnership or trust, can you use your self-directed funds to actually invest in into that organization? The answer is yes and no. Yes, if your percentage of ownership, including your spouse, is less than 50% of the total ownership. So if you own 49% or less and you don't have majority controlling interest of that organization, you could use your retirement funds to basically either start or to expand an existing business if you basically fall within those rules and those guidelines. For more information, feel free to give me a call and we can talk a little more extensively if you were looking to move in that route, but that is an option that's available to you. So in summary, you have a lot of opportunities to be able to use this plan to grow the retirement account and basically make sure you have a sound, your golden years are sound and solid for you. You just want to follow those rules, and just remember the code you want to basically research and get familiar with is IRS Code 4975 and any of the subcodes. So once you get your account established and funded and you've made up your mind in terms of which investments you want to move forward with, or investments plural, the next step is to get your account funded. And these are the methods of actually getting your account funded. The first would be what's considered an IRA to IRA transfer. This would basically involve completing a transfer form where you would authorize us to initiate the request of funds, whether it be check or wire, into your account based on a specific dollar amount that you specified on the form. Usually takes anywhere from 7 to 10 business days from the time that your existing custodian receives the request for them to disperse funds over. A rollover is something that you can take advantage, or a method you can take advantage of when you are moving any type of 401k or employer-sponsored funds over to a self-directed IRA or 401k. It is usually required that you use that method to move over employer-sponsored funds, but you can also use a rollover depending on how long it takes for your custodian to move IRA funds. Sometimes a rollover could actually happen a lot faster, but be aware that you have 60 days, whether it's a direct rollover or indirect rollover, to make sure those funds are received in the new retirement account. Any day, one day beyond 60 days is considered a distribution, and you'll be taxed and penalized if you're under the age of 59 and a half. So you definitely want to, as maybe a last resort, if you're looking to use that method for an IRA, is to maybe use that as a last resort. But when it comes to employer-sponsored funds, that is the only method that you can use to move funds over to the new retirement account. Contribution, relative to the type of plan that you select or you're eligible for, you will have contribution limits, and you have up to that maximum amount, which we'll talk briefly on the next slide in terms of what your contribution limits are for the different types of retirement plans that are self-directed. You definitely want to consult with your CPA or tax professional before you make a contribution every year, because that number or amount could change every year, and the result of contributing too much funds will result in a 6% excess contribution penalty. So you want to make sure that you're aware each year how much you can contribute up to the maximum to avoid that penalty. A conversion is usually where you're moving funds from a tax-deferred account, from such as a 401k or a traditional IRA, over to a Roth IRA or 401k. This is if you're looking to pay the taxes now and want to make sure that wherever the tax rates are in the future, that you're not subject to paying any higher taxes. So in essence, what happens is you move the funds from a tax-deferred account over to a Roth account. Once you basically met two milestones, which is one being that you've had the account for at least 5 years and you're age 59 and a half or older, you pay no income tax on the growth of those funds. So it's pretty nice if, once again, you're worried about where we're going to be tax-wise in the future. So once again, definitely want to consult with your tax professional on that as well, because converting in any tax year could kick you into a higher tax bracket, resulting in you paying higher taxes. So definitely converse with your tax professional CPA before moving forward with that option. And conversions is not something that you have to convert the full amount. You also can do partial conversions. So once again, figure out what's the right mix for you after speaking with your tax professional, and you can decide to move forward. So these are the type of plans that we offer that are self-directed, and these are the contribution limits. Real quickly here, you have a traditional IRA, which is a tax-deferred account where you're able to contribute up to $5,500 or up to $6,500 if you're over the age of 50 and a half. The Roth IRA, same contribution limit, same rules, up to $6,500 if you're over the age of 50 and a half. The difference, once again, between the Roth and traditional is the Roth is a tax-free account once you've met the two milestones of that you're 59 and a half or older and you've had the account for 5 years. You pay no income tax on the growth when you pull it out. The SEP IRA, a tax-deferred account designed for those who are primarily self-employed or 1099, and your main source of income would have to be from self-employment or 1099 income in order to qualify to be able to contribute to this type of plan. It's a nice plan because, once again, outside of the traditional and the Roth IRA, as you see, it has a much higher contribution limit. You must have what's called earned income, so you want to make sure that before you make a contribution that you have earned income for that particular year. That's usually a conversation you're going to sit down with your tax professional, and he or she is going to decide, once again, how much you can contribute for that particular tax year. Simple IRA also can be self-directed. It's for those organizations that are small or medium-sized organizations with less than 100 employees or less. This is your contribution limit, up to $12,000 and up to $15,000 if you're over the age of 50 and a half. And lastly, you have what's called a 1K or solo K. It's a 401k product for those who are 1099 or self-employed. Contribution limit is up to $51,000. And how that works is you basically have two buckets that you're able to contribute into this plan. You can contribute as both an employer as well as an employee. So you have a contribution limit up to $33,500 as an employer and $17,500 as an employee, totaling up to the full $51,000. You have no catch-up provisions for the solo K. They have abolished that, so your maximum contribution up to that maximum amount would be $51,000. And you also have one other option that I didn't list on this slide. If you choose to, you can also change the employee contribution into a Roth contribution up to $17,500. So that is another option that you have available to you to contribute into that employee bucket as a Roth account. And that is something that's also pretty popular, once again, because you have a much higher contribution limit than a regular Roth IRA. You can contribute up to $17,500. So other investment options structures, once again, in addition to you having a very wide range of investment options, there's a lot of different structures and opportunities available to you to think outside of the box to grow your retirement account. Partnering via an LLC, whether it be a single member or a multi-member LLC, that is an option that gives you an option available to you that gives you what's called checkbook control and also take on some of your asset protection features as well. Partnering via tenants in common, something that's real common when it comes to real estate. Opposed to setting up an LLC, the cost of setting one up and maintaining one, if you have a few partners that you want to go into both a short-term and long-term transaction, you can actually structure a tenants in common partnership between both retirement funds as well as private funds, or a combination of all of the above, and be able to move forward with that transaction. A non-recourse loan, primarily popular with retirement, or should I say with real estate investment, but also a method that was also used when it came to precious metal investing, something you want to be very aware and very careful of before moving forward, because there's a component called unrelated debt finance income tax that could be assessed on the portion of the percentage, or should I say the percentage of profits derived from leverage financing. If you want more information on that, give me a call. I'd be happy to talk to you about that. New deal exception. I mentioned earlier that you're usually restricted from being able to invest into a transaction with yourself or certain disqualified parties. The exception or the caveat would be as long as the investment is a new investment that neither yourself or your retirement account or your spouse or any other disqualified person has an existing or previous vested interest in that investment structure, you are able to move forward into moving into that investment. So once the transaction closes, you now become a disqualified person. So what, in essence, in a snapshot in time, you can partner as disqualified parties as long as there's no previous or existing ownership interest in that investment, and you can move forward. I have some information if you want more information on that. Once again, this would be an excellent opportunity if you're looking as a husband and wife wanting to move forward with an Ascenergy investment or any other type of private placement. You can also move forward with that as well under that structure. And loaning money secured by a deed of trust and using unsecured funds. The deed of trust usually is relative to real estate, but loaning money unsecured, not something that's highly recommended, but it is an option too. You just definitely want to make sure you have everything in place and you do your due diligence on the borrower before you go that route. Even if it's not real estate or some form of tangible property, you may want to consider a UCC1, some form of collateral, opposed to just going in outright with an outright unsecured loan. But it is available to you. And with the self-directed plan, putting huge emphasis on the word self, we do not perform any due diligence, and you're pretty much on your own in terms of making sure that you do proper due diligence to result in you not losing any money in your retirement account. So real quickly, to fund an investment, in particular private placement investment, real quickly you want to make sure that you establish your account, because there's a legal IRA vesting or 401k vesting that must go into all contracts and documents. Cannot go into your name and then be transferred over. That's considered a prohibited transaction and will cancel out the transaction. You want to make sure that you fund your account, whether it be for transfer, rollover, contribution, or a combination of all of the above. Complete your direction of investment is one of our internal forms, and all your other third-party documents, in this case, would be a subscription agreement and possibly an operating agreement. Get those documents over to us, and usually within 3 to 5 business days, we can actually fund, because we do, once again, make sure that we protect you as a custodian to run it through compliance, make sure everything is in order, so in the event of a random audit through any of our accounts that you're on solid footing as it relates to making sure that you follow the rules on any particular investment. This is a flow chart to kind of give you a visual idea in terms of how the process works. Open your account, fund it, select your investment. We fund the investment. Assets are actually held in your account or within our custodianship. So if it's cash, all of our funds are actually held in an FDIC account through Wells Fargo. So any uninvested cash up to $250,000 is protected. And that's something that we wanted to emphasize because there's a lot of organizations that are not quote-unquote custodians. Custodians are usually licensed, and that's a mechanism that you want in place to make sure that it is a licensed custodian that is actually holding your cash as well as your assets in the event of default on an investment or a problem with the investment offerer, that we can basically make sure that those assets are protected. So definitely when it comes to that, you want to do your due diligence also when it comes to selecting a licensed self-directed custodian. So in summary, IRAs can hold all types of investments, not just securities. So you have the option to invest in both traditional and non-traditional investments. Partnerships and split ownerships are allowed. We talked about that real briefly there. IRAs and solo K plans can grow tax-deferred or tax-free. You want to consult with your tax professional to determine what's best for you. All plans qualify for partial and transfers and conversions. So when we say partial transfers, you have the ability from an IRA to transfer a portion of your funds or all of your funds. Usually with the 401k, you're required to, or any employer-sponsored plan, you're required to transfer or roll over all the funds. Conversions, once again, when it comes to converting from a tax-deferred to a tax-free account, you can do a partial or full conversion, but definitely consult with your tax professional. And lastly, can emphasize this more, especially in time-sensitive transactions. You want to make sure that you establish and fund your account prior to entering into contract so you don't have any problems. This is my contact information. If you have any questions relative to anything I covered today, if you have any additional questions that you want answered that we can't answer for you today, feel free to give me a call, email me. You can also follow me on social media, Twitter, Facebook, LinkedIn, Google+. And there's always information that I'm posting relative to different types of investment structures, education, and information that I'm sure you can benefit from. So with that being said, that is my conclusion of my presentation for today. So we're going to go into the Q&A session to answer any questions relative to what I covered as well as what Joey had covered over the last 15 to 20 minutes. So Joey, are you still there?
Yes, I am.
Okay. So looks like the first question that I'm showing here that come up is relative to what you covered earlier is what is the minimum investment for this type of investment structure?
$10,000 is the minimum.
Okay. And another question is the duration of the investment. You mentioned that that they usually have to lock the money in for a certain period of time. Can you expand on that a little bit more for one of the callers?
Yeah, absolutely. So it's a two-year bond. And so from the day they invest, it'd be 2 years after that. Or earlier, we do have a clause that allows us to, if we exceed our expectations, we can repay everybody before that, still not discounting the rate. Still, but to be conservative, it'd be a 2-year time frame. The bonus is paid a little after 2 years. I believe it's, let's see, January 1st. 2017 is when that's paid, and that also has the same clause that could be paid earlier without any discounts as well.
Okay. Looks like another question here is you mentioned that it's a private placement. Is it through an LLC or through a PPM?
Through an LLC with a PPM. So the answer is both. We have a private placement memorandum and company structured as an LLC.
Okay. Next question looks like is relative to what I covered. It asked about what is defined as earned income. Well, with any retirement plan, for example, you can have, for example, I've pretty much been self-employed most of my life is when I actually established my SEP IRA. So the way it works is earned income is based on what you actually show after deductions and expenses. So, for example, for those who are self-employed, they would have to make sure that after losses that sometime on your tax returns you show a loss. That particular tax year, if you're not showing any income, you have no what they call earned income, so you would not be able to contribute towards that retirement plan for that particular tax year. So that's something to be cognizant of as you basically are moving through the year and you're making a plan to make a contribution, you want to make sure that you consult with your CPA maybe mid-year to see where you're at, and especially if you're looking to make a contribution towards the end of the year, that you're not pretty much boxed out because you have so many losses to where you don't have what's quote-unquote earned income. And that's applicable to all plans, because I know, for example, you have clients who have children, and they, for example, which is I think is an excellent idea, you have children that have, minors have Roth IRAs, and they say, well, I thought they would have to have earned income. Well, what you want to do is make sure whether even if the kid is washing the car, mowing the lawn, or doing anything around the house, you want to make sure that you pay that kid. You have cancel checks to prove that you paid that kid and claim it on your taxes. And, of course, that is considered earned income for that kid to be able to receive or to make a contribution into that Roth IRA for that particular tax year. Okay, the next question looks like the 401k. They're asking about what is the steps to be able to convert over to the Roth component into the self-directed 401k. Well, once you set up the plan, you have the ability to, once again, to contribute as an employer as well as an employee. As the employee, you can contribute tax-deferred through pretty much as any other traditional 401k, or what you can do is elect to have that 401k portion as it relates to you being an employee be a Roth 401k, which allows you to contribute up to $17,500 into a Roth 401k. So that is pretty much how that would work as well. You definitely want to consult with your tax professional also to determine both short-term and long-term objectives as to whether that decision will make sense for you, both short-term and long-term. Let's see here. Joey, actually I had a question. Now, I know, once again, I kind of talked about it briefly myself as it relates to crowdfunding. I know that's one of the opportunities that you're using, or I should say platforms that you're using to raise capital for your investment. Do you want to expand on that a little bit?
Yes, yes. For a long time, for 80 years or so, when a company like ours is raising money, usually you got to go through certain channels, broker-dealer network, things of that sort. And crowdfunding, which came available to the end of October, Obama signed the Jobs Act. That allows a company like us or other companies to go onto these websites and publicly, with a 506c offering, publicly advertise what we have, and therefore let the investor have access to something they've never had access before, which is a lot of different offerings from a lot of different companies to compare and contrast them and do their own vetting and look for the diamonds versus your typical way, which is calling up your broker and then having them advise you. So it's really giving people a lot more liberty, choosing how to, in this case, self-direct their money or direct it in other ways. And it really empowers these people to find some really good companies out there because there's a lot more selection that's now publicly available on these crowdfunding platforms or these websites. And so we just recently we got on our first website, and we've done really well with it. We're very happy with it, very excited. We've got went from no views to the most viewed company in a short time frame, and so we're very excited. So yeah, that's a little bit about crowdfunding that everybody should start getting familiar with. It's here
so
to stay.
Which crowdfunding platform are you guys using?
Yeah, we're using equitynet.com, and if you go to equitynet.com, you'll see there's 3 companies there on their front page. We're one of those 3, and it's important to note we didn't pay for that. The CEO looked over our business plan and everything else, and our success is their success. And so out of all the, I don't know if there's thousands or hundreds of companies, there's a long list, but we're there. And then if you go into most viewed, you click there, we're actually we're very grateful. We're number 1 right now, and so we've got a lot of interest, and this is really helping supercharge our fundraising, and therefore that lends us to maybe exceed our expectations on when we get out there and start getting into producing these different fields. And so it's equitynet.com is the one that we're on. It's our first platform, and we're hoping to get on more since we got such a great response from that.
Now, what type of information would they find if they go to that particular website in terms of your investment offering? What type of information would they find?
Just about everything. More things than we covered here in this brief presentation. You'll find out how many investors we have, the number of investors. You'll find out our historical financials with our operations in Oklahoma, how much money we've raised so far, which is over $1 million, how much money we've produced so far, which is over $1 million. You'll find out a lot more details, intricate details that can't be covered in a brief presentation. So it's really nice platform to get in there and just on the internet, just go in there and click and find out pretty much everything about the company.
Okay. Well, this is an excellent presentation. As I mentioned earlier, we pride ourselves in terms of providing education to both our prospects as well as our clients who actually have already taken advantage of the self-directed retirement plan and always looking for additional information on potential and other investment projects. So like I said, for more information, feel free to contact Joey for information relative, more specific information on the Ascenergy investment opportunity. You can also, as he mentioned, go to their crowdfunding website to get more detailed information as well. Joey, you want to basically give your contact information again? Actually, pull up.
Yeah, no worries. I can be reached on the crowdfunding platform. You can send an email there, equitynet.com, or it's ascenergy.com, and my email is, let's see if it's here. It's joey.gabaldon@ascenergy.com.
Perfect. Okay.
And if you can't memorize that, there's a famous author, Diane Gabaldon. She's actually my cousin, so but for a lot of people that name's kind of tough. But on Ascenergy.com, there's a place there to contact, and I can be reached. And I'm really good about getting back to people right away, even if it means putting in extra hours. So
perfect. And definitely, and then here's your, I'm showing here, I just pulled up your screen here. Here's your website also. They can go there and get some information. Looks like here's some login information for you to actually get into the website. So sound like your website and your crowdfunding platform, they can gather more information and, of course, definitely give you a call or send you an email for more information.
Yes, absolutely. And we invite everybody to, come on the website, shoot me an email, leave your number if you would like me to call you back, or just your email, I can email you back, and also get on the platform, equitynet.com. Either way, but you can do a lot of, we try to put as much information there as possible without inundating people. So we try to keep it clean yet very effective. We also have a short video there that gives a summary of everything we do. I think it's 77 seconds. I might be off by a few seconds, but
okay.
It's a cute little animated video. So
right. Okay, well, it looked like those are pretty much all the questions we have, and actually perfect time because we look like we're right a little bit after 1 o'clock, so once again, I want to be respectful of everyone's time. So that is our presentation for today. I'd like to thank everyone for taking the time out to join into today's presentation. For those who joined late, as well as for those who weren't able to make it, there will be a playback of this link, this presentation that will be emailed out to all those who had registered. Feel free to pass that information along to others who may be interested in both self-directed planning as well as learning more about the Ascenergy oil and gas investment opportunity. So I'd like to thank everyone. My name is Lamarr Baxter. I'd like to thank Joey, and everyone have a great day. Thank you.
Hey, thank you, Lamarr. Thank you so much. Thank you, everybody, for your time.